Can the Aggregate RMD rule impact your retirement penalties? Have you ever wondered how the Aggregate Required Minimum Distribution rule might affect your retirement penalties? Let's break it down in a way that makes sense. The Aggregate rule allows you to combine the required minimum distribution amounts from multiple retirement accounts of the same type. This means you can take the total required amount from one or more of those accounts, which can help you manage your withdrawals better and avoid penalties. First off, required minimum distributions are the minimum amounts you must withdraw each year from certain tax-deferred retirement accounts. These include traditional individual retirement accounts, 401(k) plans, 403(b) plans, simplified employee pension individual retirement accounts, and savings incentive match plan for employees' individual retirement accounts. For many people, you must start taking these distributions at age 73. If you were born in 1960 or later, that age increases to 75. Now, how is the required minimum distribution amount calculated? It is based on the account balance at the end of the previous year divided by a life expectancy factor from Internal Revenue Service tables. This calculation can seem tricky, but it is essential for determining how much you need to withdraw. The Aggregate rule mainly applies to individual retirement accounts. If you have multiple individual retirement accounts, you can calculate the required minimum distribution for each one. However, you can withdraw the total combined amount from just one or more of those individual retirement accounts. This is not the case for employer-sponsored plans like 401(k) or 403(b) plans, where you must take required minimum distributions separately from each plan. It is critical to take the full required minimum distribution amount by the deadline, which is generally December 31st each year. The only exception is for the first required minimum distribution, which can be delayed until April 1st of the following year. If you fail to take the full amount, you will face a hefty penalty. This penalty is a 50% excise tax on the amount you did not withdraw as required. With the Aggregate rule, if you have multiple individual retirement accounts, you can strategically withdraw the total required minimum distribution amount from the account that is most convenient for you. This can help reduce the administrative burden and possibly lessen your tax impact. However, if you mistakenly fail to take the full combined required minimum distribution amount across all applicable accounts, or if you incorrectly aggregate accounts that cannot be combined, you risk triggering that 50% penalty on the shortfall. For seniors, it is vital to keep accurate records of account balances and withdrawals. Understanding which accounts can be aggregated is essential to ensure timely distributions and avoid costly penalties. In practical terms, the Aggregate Required Minimum Distribution rule offers flexibility in how you withdraw your required amounts from multiple individual retirement accounts. However, it requires careful management to avoid penalties. Employer-sponsored plans generally requiring separate, required minimum distributions and cannot be aggregated with individual retirement accounts for this purpose. Planning your distributions carefully, possibly with the help of a financial advisor, can help you comply with the rules and optimize your retirement income.